Hey, what's up, everyone? Welcome to another wealth webinar put on by the BYOB Money School team. My name's Stephen Nagy. I'll be hosting the show today on behalf of Chris Naugle, who is out in Birmingham, Alabama today at the Nelson Nash Institute Think Tank annual event. We have Chris along with Craig Yenny, who you guys know very well as the freak in the sheets, if you've been around our campfire. Of course, the spreadsheets, that is. He's the brains behind a lot of our operation when it comes to things like the debt blaster, the gains projector, the buy term, invest the difference, why IBC is better, white paper, and of course, the BYOB vault. And a handful of our money mentors are there as well, including Mike Samet, Jason Sipple, Tess Hulick, and Linus Nolt, who a lot of you know from Ask Me Anything and our various programs. So I'll be hosting the show today. Really excited to get into this. We're going to be talking about the infinite banking concept, becoming your own bank, and very specifically the BYOB blueprint and how to go from, hey, what the heck is all this? To, hey, I own my own bank, like that. And we're going to talk about it today. And I'm joined by my co-host, Mr. Brian Fouts, one of our money mentors. He's been around the industry for quite some time, has at this point helped well over 1,000 of our clients look into starting infinite banking policies, and also lives out in the middle of nowhere, somewhere out west. But what's up, Brian? How are you, man? What's going on?
Good man, good. Yeah. Excited for this event, but yeah, it's not getting cold here right now at all. It's actually getting warmed up. It actually was sunny yesterday, and I was wearing flip-flops in February in North Idaho, so that is not right at all. But yeah, it's been pretty crazy up here, pretty warm, all that kind of stuff. But yeah, happened to a lot of people this year getting started, so pretty excited about that. So but yeah.
I started in the financial education space as a licensed financial advisor, Series 7, securities licenses, 66, all of that good stuff. Worked with Ameriprise Financial. I did that out of college for a couple years. Was introduced to real estate investing. Really started to study my high net worth clients, different investing strategies outside of traditional means of things like a 401k, investing in mutual funds and index funds, and kind of the traditional path that people follow. Started studying that, getting into real estate investing. Um, I started learning about entrepreneurship, various tax strategies, and it really clicked with me, the idea of being able to control your future, control your wealth, control your money. So at a very young age, I had a incredible opportunity to really dive into that industry, start traveling with some very big name financial education people such as Robert Kiyosaki, and started to grow my network at the time. Since then, that was about 15 years ago. Since then, I've been in the industry ever since, one way or another. I've done just about every kind of real estate deal you could think of, from wholesaling to flips to rentals to private funds to syndications and everything in between. Um, have even been involved and really looked into things like storage units, land development, and even just flipping land. And so have had a lot of experience. Most recently, co-founded with Chris Naugle, the Private Money Club in 2020, and we've built that ever since. A lot of you guys know about Private Money Club. We'll talk a little bit about it today, and have been working with Chris. Building the BYOB Money School Agency since 2019. So everything that you have here today. So just a quick background, and really looking forward to sharing with you guys today. We just put on one of our really flagship events. We launched this in 2020 when COVID hit, but it was our 3-day Money School Essentials virtual training event. And we started doing these back in 2020. We did 3 to 5, 6 of them a year for several years. Last year we took off, so we relaunched it in 2026. We just did one a couple weeks ago. If you guys were on the weekend, I would love to hear your opinion over in the chat box. What do you think about it? So far, we sent some surveys. I talked to several of our clients. Everybody loved it, but I would love to hear what you thought of it over in the chat box. So what Brian and I are going to do today is kind of dive into that 3-day training, but more specifically, we picked the four. We took all of the transcripts from the weekend. We took all the questions and answers and all the chat box. We ran it through AI, and we pulled out the top four questions and mindset questions that people had when it came to the 3-day BYOB blueprint event that we did. And so today we're going to dive into those four questions, and we're going to talk about why each one is so important. We're going to try and give you guys some different analogies, some framing, and really kind of dive into it to understand, hey, if this is what people are wondering about what we taught, this might be a good way to spend a Wealth Wednesday afternoon over here on the West Coast and Wealth Wednesday morning for you out there on the East Coast, or vice
Yeah,
versa, right?
vice
So,
versa.
but yeah, Brian, so just a quick rundown of who you are, and we'll dive into this, man.
Yeah, for sure. It's interesting, Stephen, when you look at people that do infinite banking like we do, there's just an array of backgrounds. I mean, it's we have financial advisors, we got investors, you've got, life insurance people. It's just all different. So my background actually was I went to college to get a degree in construction management and business because that's what my brother did. I didn't really have any clue what I was doing, did that for over 10 years. And then I remember when my first daughter was born, I said, I need to get life insurance. And so I went to a buddy of mine, first mistake right there, and got a policy. And he goes, Oh, you want a cash value infinite banking policy? I'm like, What's that? And he explained it. And I was like, This sounds awesome. It was a VUL. It was one of the worst things I could ever have gotten, and it was horrible. But that was my first introduction to infinite banking. And then I left that career, got into real estate, kind of like Steven did a bunch of deals there. And then I was very fortunate to acquire a financial education business that I grew to multiple seven figures. But I used Robert Kiyosaki's advisors as the content creators. So I knew all of them. I would fly to their offices or vice versa, and we'd film content. One of them was an infinite banking practitioner, and he became my mentor. And that's when it all finally clicked that what infinite banking really was. I realized I didn't have a good policy. But what I learned most importantly was that the wealthy do things very differently with their money. They do things differently, like infinite banking as an example. And so that really opened my eyes. And so that's what I really love about what's going on here. What we do here at the BYOB team is we take that same knowledge and we share it with everybody else as well. And that's what I used to do in that other business as I shared financial education. So I learned a lot about it. But yeah, just helping people understand how this thing really works. But Stephen, one thing I've realized, I started doing the first webinar on infinite banking 10 years ago. The
Wow.
questions I would get then are nowhere even close to what we get today. And I think that's because of the education that's out there, the books that are available now, the content on YouTube that Chris does. A lot of people they're asking better questions now, a lot better questions. And I think it's just it shows, that the value that that Chris and everybody's doing is pretty high notch, it's pretty high level. So, but yeah, so
Yeah,
I
it's
just
really
love doing
cool.
this.
Yeah, absolutely. And you're right. Even, I see a big difference even from when I was working very closely with all of our clients back in 2020, 21, 22. Before, you, Brian, and our other many mentors, came on board and started working very closely with our clients. And, back then it was definitely a lot simpler. People would, have more general questions. It would kind of just make sense. They say, okay, let's do this. Today we really have to dive in deep with our clients. And if you guys are new to this, I'm speaking to you right now. We have different tools now, like the BYOB Vault, that we can actually visualize your situation and you can see what your plan is before you ever decide to take that leap. See, prior to that, you almost had to just take our word for it. You had to like have a little faith in there. But now at the BYOB Vault and being able to prove this stuff out using math and visuals, you can actually see it all ahead of time, which is really, really cool. And I will also say, Brian, people's financial situations are a little more complex right now, so to say. I mean, the economy, the stock market's still all-time highs, but it seems like most everyday people are struggling a little bit. We've had in crazy inflation over the last 5, 6 years. We've had kind of an interesting just economy in the United States. And it affects people. I mean, how many of you feel like you're struggling when you go to the grocery store even right now, And so, if you own a business, how is your business growing right now? Are you doing well? Are you just getting by? Are you struggling? What's that look like? And, your retirement, are your retirement dollars up? If so, okay, great. But if we enter a downturn coming up in the next couple of years, are you in a position to still be okay? Are your dollars protected? Are you doing everything you can to protect yourself there? And I'll say this last thing on that, Brian. One of the biggest changes I've seen over the last several years is real estate, the real estate industry, specifically real estate investors. A lot of our clients, in 2021, 22, 23, even, were real estate investors and they were doing great. They were out there making a lot of money, doing deal after deal after deal. It seemed like they were just happening. And all of a sudden last year and going into this year, it seems like real estate investing has become a lot more difficult and has definitely slowed
Yeah.
down. I've seen a lot of investors get out of the industry completely or stop their businesses or becoming a lot more conservative. And so it's definitely changed. What we do as a company as far as helping our clients because of what's going on out there with the economy and everything. But you want to talk that for a second? You're talking
Yeah,
with
yeah.
clients every day, you know?
Yeah, because definitely the real estate market has changed a lot because it's the rising prices not stopping. It's just doesn't make any sense. But some of my acquaintances, they're very, very high level net worth individuals. They sold, I think Mark sold 1,000 doors, or maybe it's 3,000 doors. He sold all of his real estate a handful of years ago, and just now he cherry picks deals to get into. And so he got out of the higher risk side of it and got into the lower risk side. But yeah, I'm seeing him get out of real estate quite a bit, and but they're still involved in some way, shape, or form. They're just not more on the hands-on side of it. They're more on the passive side of it now, which I'm seeing quite a bit of people doing that, or just not even getting back into it, just staying liquid. Because I remember back in, gosh, this was 13, 14, 15 or something around there. I was talking to a gentleman, Ken McElroy. I don't know if you guys know who Ken McElroy is. He's like one of Robert Kiyosaki's real estate guys, advisors. And he was talking about the '08 and 9, 10 crash. And guess what he had though? He had life insurance. And he had a whole list of people that also had whole life policies, infinite banking policies. When the market crashed and collapsed out of real estate back then, he went in hard and he quadrupled his holdings. He had about 14,000 doors all of a sudden. He did that because he was liquid. And so and he did it through real estate and just bought, properties at pennies on the dollar. And so I know a lot of people are thinking the same thing right now. Hey, if real estate does go back down again or the market takes a hit, how can I get back in? How can I take advantage of it? Well, the way to take advantage of it is you've got to be prepared. You've got to prepare ahead of time. You don't watch the market crash and then decide, oh, okay, now I'm going to get in. But if the banks aren't lending, you can't get access to capital, you can't take advantage of it. And so I've had a lot of clients that did the same thing. They did it the COVID, by the way. So when the market crashed in COVID, they had policies, they wouldn't use that to go get assets that were all of a sudden at a discount. So you can learn what to do today by looking at the past because it repeats itself. And so like right now, I want to do real estate. I really want to get back into it. I want to do it on the affordable housing side instead of I was doing flips and lease options before and subject to. I want to go more on the mobile home manufactured home side of it because the price point is a lot different, and the area that I live in now, it's prime for that. There's a lot of that around. So I'm thinking ahead of time right now. So when the market does take a turn, I can take advantage of it. So just kind of keep that in mind. What can you do today to get ready for what might happen down the road?
Yeah, and TC said, would you guys be able to assist from zero to go on setting up everything like Nash, from trust will to the generation, wealth bit, and what do you charge? And that's a great question, and we're going to get into that today. But before I answer that question, let me just share my screen for just a second. So, a lot of what we do, first off, what we do is we teach you how to take back control of your money and solve your money problem, and we do this through a very personalized approach to your finances. And the reason for that is every single one of you on here is in a different position right now financially. So first off, if you're the kind of person that you're maybe have quite a bit of debt right now. Maybe you're making some money, but it's just bleeding out to debt and other things in life. Maybe you're struggling to put any savings or investments away. Maybe you got a 401k going, but you're like not like getting ahead. Maybe you're not completely, underwater, but you feel like you're not really getting ahead. You know that you need to go out there and actively somehow generate more money so you can put stuff away for the future. And I ask this question because then the reverse side of that is somebody that has some investments. Maybe they have 401ks, they have IRAs, they have non-qualified, brokerage accounts. Maybe they have some real estate. Maybe they're making money and they're stocking it away in savings accounts or, other instruments like that. And they are thinking to themselves, hey, I'm doing good. I'm putting money away, but I just don't know if I'm putting it in the right places. I feel like I'm paying too much in taxes. I know that I could be smarter with my investments. I don't feel like I'm confident for a market crash. If that sounds like you, where you need to be smart with your money, make sure it's protected, you understand it, and make sure that you're making that dollar go as far as it can. And you're put passive in the chat box, just as a nice common term, passive right there. And so when we teach you how to take back control of your money, each one of you has a different money problem. Some of you need to go make more money and be smart. Some of you need to have the money you're making make more money. And that's what's going to put you as some of you needs to be smarter with your retirement accounts and what that looks like. And so it's hard to talk about all this stuff in 90 minutes on these wealth webinars. Now, we a lot of times will focus on one topic like the infinite banking concept, like the private money club, like real estate investing, like self-directed IRAs, tax strategies. So, continue to come to these wealth webinars regularly every single week because they're always different. The challenge today, Brian, that we have is talking about everything we taught during 3 entire days. I mean, those days were 7 to 8 hours long each. We asked the survey and we got some feedback. One of the feedback was, "Hey, I love you guys are going all day. I love it's virtual, so I can get up, and I love there's recordings. So if I miss anything, I can go watch the recording." He's like, "But could you give us like a 20-minute break in the middle of the day, like something that I could just turn my brain off for a second?" So maybe we'll do that in the next one. We'll see. But it's just funny. So we do go on. So it's 3 full days, and we do start on Friday with the mindset. And to me, the mindset might be one of the most important pieces of the entire weekend because you really need to change the way you think to be able to understand what we're going to teach you to do on Saturday and Sunday on the next 2 days of the 3 day. And so let me just give you a quick example of that real quickly, okay? So this is something I've taught for a long time. It's what I call why aren't more people successful, specifically financially, talking about the mysteries of money. And I've coined the term the wealth killers, okay? And these are the four wealth killers that I found. If you can learn to build strategies and if you can learn to have a plan around these four wealth killers, you can put yourself in a much better financial position without doing anything differently. Okay. You can continue to work your job, your business, your investing. But if you can learn how to control those four wealth killers right there, that one aspect right there is going to put you in a much better position. So we go on deep during the 3 day virtual training on those four topics right there. For example, somebody was asking about trusts and wills and setting up their family foundation, their family constitution. How do you plan estate planning? How do you do this the right way? Well, we have a professional come on and he spent 2 different sessions talking for over an hour on each one on those strategies specifically. Because, one of my mentors taught me a long time ago, one of my tax mentors, there's two tax codes in this country,
Yeah.
one that the wealthy follow, one that everybody else follows. Both are legal. Which do you want to follow? Well, the one that the wealthy follow makes a lot of sense. And you guys heard Chris on that What Now, What Next video that was playing before we started here. He was talking about Elon Musk, how Elon Musk pays historic taxes, but he also pays no taxes. And how is that possible? And again, this is all legal stuff. And I'm sure all of you have heard this stuff. I mean, you hear business owners, people like doctors that are financially intelligent, they'll say, "Hey, a lot of times my secretary pays more in taxes than I do." Nothing wrong with that. It's all part of the game. And so if you can put more dollars in your pocket instead of paying it to the federal government, state government, whatever, and you can take that money, reinvest it, grow your business that much faster, get it going, you can put it into good causes on your own. Why would you not do that? And these are simple strategies that every single one of you on here right now can start doing immediately, right?
Yeah.
Number two, inflation, Brian. I mean, inflation,
Okay.
everybody knows about inflation. It's been hot the last few years, right? I mean, so we teach you different strategies like becoming your own bank, having your money in a vehicle that compounds uninterrupted, guaranteed, tax-free for the rest of your life. So while you have that compound growth, that way your dollars are now at least trying to keep up with inflation, keeping the money moving, introducing you to a bunch of different opportunities that you can put your dollars into to keep those things growing. So one of the easy ways to start getting rid of inflation wealth killer is don't have your money sitting in a savings account under a mattress, buried in the backyard, whatever. Have that money in a smart vehicle that's growing for you all the time, even simultaneously while you're moving that money. So we call it the little green men, taking all your dollars that you earn. Those are your little green men, putting those things out on the battlefield and have them dominating the other green men and bringing them back to your home, right? Back to your castle. And that's how we're going to keep our money moving at all times and eliminating like inflation, for example. I'm just giving you kind of just a quick little example of this, like I said, but volatility. I mean, Fouts, you were doing financial education back in '08. I mean, how
Oh,
many people were truly ready for 2008 and the volatility of that game?
virtually nobody was. Virtually nobody. I mean, I do know people that were because they saw the writing on the wall, but the majority of people were, I would say, not FOMO, but they were riding that wave and just oblivious that, hey, that this it goes both directions. And right now we've been in the what is the longest bull run of history. I mean, that's kind of scary, but volatility. But what's the thing they say, Stephen? What goes up must come down, but which one is faster, up or down? So when
Yeah,
the market
yeah.
when it comes down, it goes down fast. Think about in 2020 when COVID hit and the crash happened. I mean, I don't remember how fast it went down, but I do remember that I was day trading oil and they locked it. They stopped all trading because it was crashing so fast. So it goes up slowly, but it comes down fast, and most people are not prepared for that.
Yeah, I mean, we see it all the time. You see it even in cryptos, even in precious metals right now. I mean, this crazy upward trend, and then boom, in like a day or two, it all fell back down quite a bit. I mean, so we see the volatility. I mean, I'm sure everyone on here knows somebody back in 2008 that was planning to retire, had to go back to work, had to get another job, lost their home through foreclosure. So this volatility, especially when you're not expecting it, can cause a lot of problems in your financial life. I mean, the number one cause of divorce in this country is due to money and fights and arguments and stress around money. And so it's sad to see and there's so many things you can learn today. But here's the thing with volatility and really all of this that we teach is it doesn't you can't be reactive to it. Okay, you can't wait till it happens to say, okay, let me make a change now. You can't wait for the market to crash before
Yeah.
you position yourself in a way. Now you could take advantage when the markets change. You could take advantage of these market conditions, but you have to be prepared for them. You have to be pre-active and ready to go before they occur. You cannot be reactive. And so now is the time because I don't know what all of you think, but when you look at the markets and the all-time highs we're at and the national debt and everything that's going on in this world, at some point we're going to see a correction. How big of a correction that is, I'm not sure. But the bottom line is we've never seen a bull run like we've seen in history that we have today. We've never seen more money printed. We've never had a higher national debt. We've never seen real estate prices the way they have for so prolonged time. Nobody can afford, first-time home buyers can barely afford to get by. Rent is still very, very high. So we're at this perfect storm almost where we're gonna see some kind of correction. And are you ready for that? And that's what this campfire is all about, is teaching you, make sure you're ready for it, make sure you're positioned to take advantage of it, and we'll go out there and do well. And then of course the last wealth killer is interest. And those of you that have been around and study the infinite banking concept, the amount of money that's bled out in interest is unbelievable when we look at how much people pay in interest. And all interest means is if you've ever financed a car. Think about it. You go to the bank, you get a loan, and then you pay interest on that loan. Where does that money, that interest go? To the bank. Same thing when you buy a house, right? You get a mortgage, you have interest on that mortgage, you pay it to the bank. The student loans, you're paying it to a bank. Personal lines of credit, you're paying it all that interest to the bank. So over the lifetime of a human, especially if you look at it annually, the amount of interest and all interest is money that's no longer ours that we're giving to somebody else. So the amount of money that we give away through interest to other people it's actually sickening when you actually add it up. And we do this
Oh,
stuff all the time. Like when you actually show yourself how much you're losing to interest, it's crazy. And so all we do is becoming your own bank, changing one thing, where your money goes first. And by putting our money into our own banking system, into a specially designed whole life insurance policy first, and then doing everything else we do anyways, eventually we're able to use that specially designed whole life policy, that vehicle, our own banking system. We're able to use that for all of the purchases in our life. And then when I take a loan from my banking system, who am I then paying interest to? Myself. Back to my banking system. Instead of all that interest bleeding out to all these other financial institutions, let's stop making Chase Bank, Wells Fargo, Morgan Stanley, all these banks. Let's stop making them rich and let's
Agreed.
enrich ourselves and our families. And that's all that is right there. Changing one thing where the money goes first and stop the bleeding. And so, like I said, we spent 3 full entire days talking specifically about these wealth killers. And the reason we talk about it is because I'm the one who designed and structured the 3 day training. So that's why we focus on those topics because I know for a fact those are the most important things you can do right now without changing much else in your life that will put you in a much better position financially. From there, once we have our foundation built, then we could go out there, we could start a business, we could start investing in real estate, we could start buying rental properties. But let's start with that foundation. Make sure we have that set up properly, and then we can go out there and really start growing wealth. But to be able to do all this, you do have to have the right mindset. So let's just talk about that for just a second, Brian. So following the
Yeah.
status quo, I mean, how many times, Brian, do you talk to a client and they are hesitant or they don't get started with a strategy because they are scared of a spouse or their parents or their kids or a good friend of theirs tells them not to do it, or like you said, they have a friend that's an agent and they said, oh well, I or a financial advisor, and they're like, those guys are full of it, or something like that. I mean, how often do you hear that?
Every day. So I call that the circle of influence. Like, who's your circle of influence around you in your life? And if you look at those individuals or those people, oftentimes you're getting the same results as them, or vice versa. And so that's a big issue right there. And I truly believe that we are taught or we are programmed to get bad debt, to create bad debt in our lives. And it's a perpetual cycle, by the way. But the mindset to, have is, well, if I go get bad debt, what's that doing on the other side? It's good debt. It's making somebody else wealthy. And so if you follow the status quo, typically you're going to be in that perpetual cycle of just bad debt, bad debt, bad debt. Pay off this car, get another car loan. Get rid of that car loan, get another car loan. It's just that vicious cycle. But when I was studying with Robert Kiyosaki's advisors, I saw how they do things very differently. They create good debt first, almost always. They don't create bad debt first, a mortgage, car loan. They'll go create good debt, rental property, an investment, a business that cash flows. And then when I looked at what they're doing, oftentimes there's bad debt involved, but they don't have the bad debt. They own the good debt. And so it's a hard shift for a lot of people mindset wise to understand that because of what we've been taught.
Absolutely, man. And a good example of it too, Brian, is a 401k. I mean, why do so many people invest in 401ks? And you're giving up control of your money. If you need it back, you gotta pay, if you need to pull it out of there, you're gonna pay not only taxes on it, but you're also gonna pay penalties and fees. You're limited to what you can invest in 40, most 401ks,
Oh
maybe the
yeah.
stock market, things like that. So you're giving up control. Most people say, well, I'm not going to pay taxes till late. Well, you're still paying taxes on all the growth, on all that money that's growing, and they're still paying taxes on it later on when you do withdraw it after 59 and a half years old. But why do so many people still invest in 401ks? It's because it's what's always been done, it seems like. And I could give you 100 different examples of that, right, Brian?
Well, yeah, but it's only been around since the 80s. I mean, 401ks haven't been around a whole long time in reality. But the reason why we do that is because we're not taught anything else. We're not taught something different to do. Hey, you go get your first job, they shove this paper in front of you, say, sign this, and that's your 401k agreement, and there you go, off to the races. But why is it pushed so hard? Well, because there's no risk to the employer. There's no risk to the 401k custodian, the ones that get fees. The risk is all on you. So it's all about risk, and they don't want the risk. They want you to have that risk. It's pretty crazy. But it's kind of interesting. And there's a WTF or a Wealth Wednesday that I did with Andy Tanner. We talked about this exact thing. The 401k, the guy that created the 401k, that designed it back in the 80s, doesn't even use one, doesn't even have a 401k. He has what he calls a 501k. Anybody want to guess what a 501k is? It's a life insurance, whole life insurance policy. So it's crazy enough. The guy that designed the 401k that people are being shoved, into doesn't use that. He uses whole life insurance to become his own bank.
Wild,
So
man.
it's
Yeah, and,
wild.
and and I could give you example after example. So we have to have the mindset right. You have to be willing and have an open mind to learn something new. And the last thing I'll say on
Amen to
that
that.
is most of what we teach, Brian, is nothing that we actually came up with or
Right.
invented on our own. I mean, most of what we teach is from years and years and years of experience, going out there doing it ourselves, studying this stuff on a daily basis, and really just mimicking what some of the most wealthy Some of the most wealthy families in this country do. People like the Rockefellers, the JPs, the Morgans, the Chases, they all use these strategies. We study what the wealthy do. Chris Naugle was a high-level financial advisor for 16 years, working with high net worth individuals. Like I mentioned, that's what I've done for the last 15 years. So we study this and not only what the wealthy do in this country, but we also study what the banks do. Because if we're going to teach you to become your own banker, then let's mimic what the banks do. And so a lot of what we teach is nothing new. It's proven systems that have been around forever that most people just never learned about. This stuff's not taught in high school. It's not taught in college. You don't learn about it unless you seek it. Now, the beautiful thing about the world that we live in today is there's a lot of financial education out there. Now, I will give one warning though. There's also a lot of bad financial education out
Yes.
there. So when you hear Brian earlier say something like, his friend sold him a VUL, you're going to hear a lot of things about things like IULs. Why? Because they make the agent a lot of commission. They're not great for you as the client. And same with financial advisors. I mean, when I was with Ameriprise Financial, we sold the funds that Ameriprise owned, and that was it. That was all we sold. We were captive. And so we would offer things that presumably paid high commissions. And you see this all the time. Now, there are good advisors out there. There's great agents. There's other people out there that share good information. I'm just saying be very, very careful. One of the cool things about our community is we do live events. We encourage people to network. We have in-person events constantly where you can come out and meet us in person. You can meet other people that have worked with us for years and years and years. If you've been following the chat box, you'll see people that have been coming on these wealth webinars and working with us for years and years and years and years. And they'll tell you firsthand, hey, these guys do nothing but tell the truth. They have an incredible network, and the people they bring on are ethical, moral, and teach the right thing. And so, if you guys like the sound of that, you're definitely in the right place, and that's what this is all about. And I know that was long-winded, but I wanted to come back real fast to what TC said, which was, would you guys be able to assist from zero to go on setting up everything like Nash? And what he means by Nash is what Nelson Nash teaches. He wrote the book Becoming Your Own Banker, which again is what we teach. If you've ever watched our 90-minute presentation, which all of you should, if you haven't, I'll show you the link in a second in the chat box. Go watch that. That presentation is based off of the Nelson Nash book, Becoming Your Own Banker. Okay. And so he said, helping with trust and generational wealth absolutely will help with all of that. So if you are on here right now and you need to hop off early or you're ready to take action, there's two things today you can do immediately to help yourself get started with all of this. Number one, we do have the recordings available for purchase from the BYOB Blueprint event. So I put the link over in the chat box right there. Go ahead and click that link. You just put in your basic information and you can purchase the recordings. They're time stamped. I would recommend start from day one and go through all 3 days, start to finish, but you can jump around. You can watch the sections that you want. So if you specifically just want to learn about trusts, watch the two parts that Brent Carlson with Corporate Capital talked about, and that'll set you up nicely. If you want to learn about a family constitution, watch what Jason Sipple taught. Okay. If you want to learn more about infinite banking and kind of the basics, watch what Hannah Kessler taught when it came to IBC. Okay. So there's a lot on there. Also, we are here for you. So we don't only just teach this stuff, we also implement it for you. So Brian, myself, our entire team, we are licensed life insurance agents. We are licensed and contracted with some of the biggest mutually owned life insurance companies in this country that work with us to build these infinite banking policies. Okay. So if you guys like what you hear, you're ready to get started or explore what that looks like for you, schedule a call. So the second link that I put over in the chat box is the schedule call. It's completely complimentary. It's free. We never charge for any of these services. We do a video call with you, or if you prefer the phone, that's fine. But we'll talk about your situation. What debts do you have? Where are you today? Where do you want to go? What's that look like for your family? How much money do you make? Things like that. And again, we're going to hit on the four most common questions in just a second. But that's what that call is for with our money mentors. It's called a strategy call, and they're going to spend an hour with you going through this. And as many calls as you need to make sure you're comfortable to move this forward, that's what our money mentors are there for. So there's two things you can do for yourself. Buy the recordings. They're $49. We take that $49, we put it into ad spend for the next event, so we can bring more people into the campfire. So 49 bucks for the recordings if you would like those, and schedule a call with our money mentors, completely complimentary and free. So with that being said, you ready to dive into some of these questions, Brian?
Yep, let's do it.
All right, cool. Let me just hit the Q&A real fast while I pull that up.
Yeah, I
So
was gonna say you
Kurt
gotta set up
said, when can I use my Roth IRA?
when you're 59 and a half. No, that's just a Roth, so it's a bit different. But
Yeah,
um,
but generally speaking, yeah, any kind of IRA, you're going to get penalized for if you're pulling the money out before 59 and a half. Now, with a Roth, they do have some first in, first out or cost basis, right? Where you can pull the money because you're paying taxes on it before it goes into the IRA. You already pay taxes. Um, and in a Roth, it's tax-free growth. And we do talk about Roth and traditional IRAs on the 3-day, just so you guys know. But Kurt, you can start withdrawing from the Roth tax-free after 59 and a half.
yeah, and then TC, your question about the 401k is very similar to the Roth one. So keep in mind, a Roth 401k, those are QRAs or qualified retirement accounts, which means bottom line, they're under the control of the IRS and not you, by the way. So can you move a 401k QRA into a life insurance policy? Not directly. That's called a rollover in the QR in the retirement world. You cannot roll a 401k over to a policy directly, but you can do it indirectly, which means you've got to either take a 401k loan, which you got to pay back, or you permanently withdraw the money from the 401k, which, as Stephen alluded to, 20% taxes in most cases is held off. Sometimes it's not. Sometimes they'll give it all to you and then do the taxes when you file your return, um, or, or and the 10% penalty. So just kind of keep that in mind. It's an indirect way to do it. Now, this is fun. I have a client that did this. They actually took money out of their 401k. They didn't hold the taxes back, which I had not heard that very often. But they didn't take the taxes out. They'll do it when they pay their taxes down the road in April. But what they did is they put all the money through a policy, and then they'll borrow from the policy to pay the taxes. But the key thing is they maintain control of that money for the rest of their life. So that was pretty cool. But that's hopefully that TC that answers that question for you.
Yeah, I love it. And most 401ks are captive, meaning you cannot do anything with them until you leave the job or retire. But if you have old 401ks, that's one of the best ways to convert those over to a self-directed IRA and maybe even do a backdoor conversion into a Roth while you're doing it to set
Mhm.
yourself up for that tax-free growth, through into retirement. So lots of strategies like that, very, very powerful if used the right way for sure. So,
Yeah. Dex
um,
actually just said that's what he did. Yeah. Yeah. But I mean, I do have people that are borrowing from the 401k, the 401k loan, 50,000 or 50%, whichever is lower, to fund their policy. And then they're paying back the 401k and then they're using the policy to create more cash flow. So there's just lots of options. So, some people get pretty creative.
all right, cool. Brian, ready? Give me a drum roll for the first of four big questions from the BYOB 3-day virtual blueprint event. You ready?
Yep.
Question one. This is an easy one.
Yeah.
How much money do I need to start? But in reality, we get asked that a lot, right? And it's a great question. They're like,
It's
okay, I'm
it's
going to
one of the number
start
one
a
questions.
banking system. I want to put some money in it, but how much do I put into it? What does that look like? So, what do you think, Brian?
I mean, the question, it's a good question to think about, but the answer is whatever makes the most sense to you. But having it make sense to you might not be there at the very beginning. So part of what our, I don't want to say job, but our duty to do is to help you answer that question. Because I can answer it for you because it might make perfect sense to me, but that doesn't matter if it makes sense to me. It has to make sense to you. So our job is to help you do that. But what happens a lot of times is people ask this question, well, what's the minimum amount? And we'll say, oh, it's 10 times your age per month as an example. Okay. And then what happens is that people say, oh, then that's the recommended amount is 10 times my age per month. No, it's not the recommended amount. It's just the minimum to start a policy. So what makes the most sense, first off, is looking at what your money is currently doing for you. Where's your money going? Where's it coming from? So we're going to ask these questions, by the way. Hey, how much do you make? What are your expenses? What's your debt? Where's your money going? How much disposable income do you have? So there's lots of different answers to this. So the first one I'll answer is where is your money going right now? What bucket is it going into? Is it going into a 401k bucket, a savings, IRA, pension? Where's your money going? Because once you understand where it's going, then you can look at and say, hey, is that where I want the money to go? That's a question I always ask is, hey, are you happy with where your money's going? Some people will say, well, no, it's going into a 401k. I don't like that. I'm like, okay, then an option you have is to just redirect the cash flow. Instead of having it all go to the 401k, have it go to infinite banking. That's one way to look at it. That's one answer. Another answer, as I'm going to look at, is what are you currently saving any money? What do they always recommend? 10% you should be saving, or 15% you should be saving. So are you currently doing that? Do you have good money habits? That's what I'm actually trying to figure out, by the way, when I ask that question is what are your money habits, good or bad? Because if you have bad money habits, we do not want those bad money habits coming over to infinite banking when you start a policy, because you're just going to repeat the same thing, and that's not good. So we want to understand, where's your money going? What's your money habits? If you have good saving habits, then infinite banking can be one of those buckets that you save money into. Um, that can be a good one. Another answer to that question, which just happened yesterday, and this was the person that asked this question had a good mindset, but they asked a follow-up question. So they said, "Hey, Brian, I want to put in $2,000 per month." I'm like, "Okay, cool, that's fine." Their math made sense. They have pretty good income, so they could do that pretty easily. But then they said something, and they said, "Well, Brian, I want to start policies on my spouse and my kids next, maybe like next year." So what I then asked them, I says, "Well, how much do you have to put towards their policies?" And he kind of stopped and goes, "Oh, well, I guess it's just $2,000." I said, "So do you want to commit $2,000 to your policy and then have nothing left for the other ones, the premiums I'm talking about, deposits?" He's like, no, I don't. I said, so here's part of how I look at this. If you have a dual income household, as an example, let's just say that you make $200,000. If this guy did make the majority of the income. I said, well, if you make $150,000 out of the 200, then the majority of the premium for infinite banking should go to you. And then the other income earner, his spouse, by the way, would have a smaller policy. And that's because of death benefit, by the way, because there is a death benefit that is there to replace lost income. So the answer to that question is definitely multifaceted. It depends upon the individual. Um, so I know, Stephen, what do we have to add to that one? Because I know, like, I could keep on going.
Yeah, no, it's a very personal, situation, and that's one of the reasons I said, when we do that strategy call, that's a big part of what we talk about. What does fit your financial situation today? What's that look like moving forward? I mean, for most people, they start smaller than they think, I think, once we actually look at what you have going on. But the way I like to look at it is almost like a ladder, you don't have to reach the top of the ladder today. You start with the first rung and you slowly start climbing your way up. And so the bottom line is you have to start somewhere. When you start a garden, you don't need a greenhouse. You just need a single pot and then you grow from there. And that's the way I look at these policies because, if you even if you want to start this out as a guideline minimum, like you said, 10 times your age on a monthly basis. Great. That might not be a lot of money, but it's a start. And here's the thing is once you get to the point where you're like, okay, now I understand this more. I'm doing better financially. I paid off some debts. I can now grow my banking system. It's very simple. You just start more policies. And so you can start adding policies on, and you can own as many life insurance policies as you want. You have to qualify for them, financially and medically, but as long as you qualify, you can own as many policies as you want. I mean, I own 4 policies. I know it's not a lot. I think Naugle owns like 16 or 18 policies now. I know Kessler is up in the 20s, so you just keep growing your banking system as you grow financially. And on the flip side of that, there's a lot of flexibility in these policies as well. So if you start at, let's just say, $10,000 a year and something goes wrong financially in your life and you're like, oh man, you come up to your year and you're ready to put another $10,000 into your banking system, but you just don't have it. Well, you have a lot of options. I mean, number one, you can change to monthly payments. So instead of the 10 going in all at once, you could switch over, pay monthly. You can drop all the way down by about 60 to 75%. So instead of putting in 10 that year, you could drop it all the way down to 2,500 to 4 grand, depending on how it's structured. If you've had the policy for several years, you could have the policy dividends fund themselves. You could take a loan to fund the policy for a while. I mean, there's so many different things that you can do to help with that on the backside of that. And so when you're ready to grow, you open more policies. If things don't go as planned, and you in a hard financial position, you do have flexibility on the downside to lower it as well. So really, it's up to you at the end of the day how much to put into this thing. I mean, out of
Yeah.
the thousand or so people I've helped start policies, I've never told somebody ever how much to put into it. It's always them after we've discussed their situation, looked at what they want to accomplish, they determine how much they want to put into it.
Yeah. And also another consideration is, I mean, even though we don't focus on the death benefit, we focus on the living benefits, there still is the death benefit conversation that should happen. Because what is that death benefit even there for? Well, it's there for generational wealth. Of course, we like that aspect of it because it's guaranteed and tax-free, but also it's there in case something unexpected happens. There's that death benefit to cover that lost income. And so I have conversations with people every day about, yes, here's the policy and what we're going to do with it, but also, what is your death benefit need? Do you have an adequate coverage in your household in case something does happen? Because that can be detrimental to a family. So that's another conversation that we even have. So how much I start, that question is more geared towards the policy, but it can also go into death benefit conversations. I'll have clients that'll do a whole life policy for infinite banking, but the death benefit's not going to be huge or anything, and they might have, a couple of mortgages or something like that. Then we'll do a second policy, but it's going to be a term policy. Now, we don't promote term insurance and that kind of stuff, but it does have a purpose. So in this case, this was a couple days ago, gentleman has a $500,000 approximate mortgage. His policy is a very small death benefit. So he's going to get a term policy for, I think it was 10 years. In case something does happen, his family can take care of that mortgage with that term policy. But after 10 years, the mortgage will be gone. Get rid of that term policy. So term is for a specific purpose for a specific period of time. So just kind of keep that in mind. And then TC, you have a question here that's kind of related to this one a little bit, and you're asking how much coverage can we get for $500? Now, when you say coverage, you're referring to death benefit. So this is the opposite of like traditional insurance where you go and he say, "Hey, Bob, insurance guy, I want to have $500,000 of death benefit." Okay, it's going to cost you $100. This is the opposite. We're looking at how much are we going to fund this with? Are we doing a dump in? Okay, all of these things, including your age, gender, the insurance company, the product that we use for infinite banking, and the structure of the premium, all is going to dictate what the death benefit is. So we typically don't, we might have a general idea what it is, but until we know all those factors, so TC, not knowing knowing your gender, but not knowing your age, how much we're looking to put into this kind of thing, the structure, if we're doing a dump in, I don't know. We don't know. It could be 100,000. It could be 500,000. It could be a million. Just depends.
Yeah. And that's the other thing I wanted to mention. You said dump in real fast, Brian. So when we
Yeah.
talk about, how much to fund a policy with, you can put the money in monthly, quarterly, biannually, annually. So the mode is completely up to you. But the other flexibility we have in that is being able to put a large lump sum in up front. And we do this quite often. It's kind of a way to jumpstart your banking system. So as an example, let's say you want to put $1,000 a month into a policy, 12 grand a year. Well, you could dump in $100,000 in year one up front. And remember, when you put that $100,000 in there up front, within 30 days, you can borrow back out, I don't know, 90% or so of that immediately to get that money back to work. But it gets it in there and starts that uninterrupted, guaranteed compounding tax-free return within the policy. But the cool thing is you're not putting 100 grand in a year. You just put that in up front to jumpstart it and then put in, whatever you're comfortable with, moving forward. And so there's a lot of
Yeah.
flexibility, like I said, on these.
And actually, see, where is that right here? I'll just share this really quick. So this is an actual illustration right here, and you'll see these two numbers that are circled. So this is a 10,000 premium and a 50K dump in, and you'll see it here, 60K went in that first year. They have access to 55,000 of cash value, but you'll see in the following years, they don't have to put in that 60,000. They can just put in the premium, but they injected a lot of money up front to get a lot of cash value and higher dividends right off the bat. So these, as Stephen said, these are pretty flexible, and there's quite a few options as to how you can fund it up front.
All right, cool stuff. And then Anonymous was asking just a little bit about their situation, the whole life. if they put it in and they said, does it actually make financial sense to use whole life instead of investing in the S&P 500? And it's a great question. Craig actually wrote a whole white paper on the
Mhm.
whole, buy term, invest the difference versus the infinite banking concept. And we did a wealth webinar on it. What was it? Just last week, right, Brian? Was that
Yeah. I
the
think,
buy term?
yeah.
So
No.
give me a second and I'll get the recording and I'll send it over to you as well as the link to download that white paper so you can check it out because that's a good
Yeah,
question.
definitely recommend checking that out because I'm anonymous attendee. I'm reading your question here, but I'm not understanding the math because I don't have that in front of me. But yeah, when he did that whole thing, Craig did it. I mean, the policies will typically beat out the market. But it's long term, of course. We're not looking in like the first, couple of years. We're looking long term, 20 years usually. It will definitely outperform it in most cases. But the thing about the markets is we don't know what it's going to do. We can only look historically what it's done, up and down volatility. With the infinite banking policies, they have a lot more consistency tied to them. We've seen policies that are 10, 20 years old, and they are very close, if not almost the same as their illustration that started the whole thing. So they're pretty accurate. And then you're asking the last thing that you ask is, does it actually make financial sense to use whole life instead of investing in the S&P 500? That's a question that we can't answer because we're not licensed financial advisors, so I won't give that advice. But if I was to talk to you about that situation, I would just do the math for you, and then you can see it yourself and then make your own decision. That's really the best way to do it. Is just to have the right knowledge so that you can make the best decision for yourself.
Love it.
Yeah, because the 320 to 350 of cash value for 20 years. If you put $1,000 into a policy for 20 years, you'd have a lot more cash value than that.
Yeah.
I'm just going to say that right there. You
I,
would.
I would recommend it looks like you have a specific situation. Definitely schedule a call with our team. And Brian, by the way, if you want to if you
Yeah,
guys want to schedule directly with Brian, that's definitely an option as well. Assuming you have time, Brian, on your schedule right now. I know
yeah,
you're working with a lot of with some clients already, but do you have room for new clients?
yep,
Okay,
yep.
cool.
So there's
So if you
my
guys
there's
want
my
to book
contact.
directly with Brian, he just put his link over in the chat box as well. Sorry, man, I wasn't even thinking about that.
No worries.
All right,
Is
cool.
it,
So let's move on to the next big top four questions, which is question number two: is this an investment? So, we get a lot like, so it's not an investment. It's maybe more of a financial environment. Investments grow on top of risk, where banking grows really with your control as a guarantee. Another, cool thing about banking versus investing is, Warren Buffett's number one rule, don't lose money. But let's talk a little bit about that, Brian. Is
yeah,
infinite banking an investment? Is a whole life policy an investment? And while you're hitting that, I'll go pull that white paper and get it ready.
yeah. So what I hear that we get this question quite a bit, of course, that's why it's in this list. The question I always ask, and obviously, unless you're in the industry, you might not know the answer, but it's a good question. What does the IRS consider it? That right there is probably the best thing to think about. Does the IRS consider a whole life policy to be an investment? The answer is no, they don't. They don't consider it an investment. So the question then is, well, can a life insurance policy become an investment? Yes, it can. That's called a modified endowment contract, which is if you do that, which is very hard to do. We don't create MECs. It's called a MEC, MEC. If it becomes a MEC, then it becomes taxable, just like a 401k, an IRA, a qualified retirement account, any of those kinds of things. So when we build these things, it is not an investment because it is not considered one by the IRS, in my opinion. An investment involves a risk as well, by the way. You can lose money in when you have a structurally or correctly structured policy, it's not going to go down in value. Whereas like an IUL can potentially do that. My VUL, by the way, would lose all of its value if I kept it. It would go to zero. Those are investments, in my opinion, because they're tied to the performance of the market and have volatility tied to them. So I always say that the investment is not the policy. What you do with the cash value from the policy can be the investment. So, like if you want to do real estate as an example, go through the policy first, then into the real estate. So that's where I always mention there. In additional to this, you have guarantees with a policy. So it's guaranteed to grow. Whereas a lot of investments, they don't have a floor. It can be negative. You can lose money. Whereas with these ones, the way they're designed, they have guaranteed growth. You're not going to lose that money. So
Love it, man.
and
Love
then
it.
I like this quote that they hear. It says, "Don't confuse the soil with the fruit. The system is the soil, the investments are the fruit. So I always look at it this way as like your policy is it's your banking system. What you do with the money and what seeds you plant, those are the true investments out there.
All right. And I'm gonna put that and yeah, it's important to understand that the whole life policy is not an investment because we really don't want to look at it that way. We want to look at this whole life policy as a warehouse of wealth. It's where we store our money. It's protected in there. It's growing for us at all times, tax free. It's guaranteed to grow. We have access to it whenever we need it to go out there and use it. So, in that environment, risk free, which as an advisor is like a big no-no. But that's the beautiful thing about this. It's risk free, right? It's
Yeah.
guaranteed growth contractually inside of there.
Yeah.
And so, that's not what an investment is, like you said, Brian. But the cool thing
Risk.
about it is you put your money in there, so then you pull it out, and then so there's no risk there, but you pull it out and then you invest it and you take on risk yourself. And the big difference there is, let's just compare it to a 401k, just as a quick example. A 401k, you're taking your money, you're putting it into index funds or mutual funds or various stock market companies. Well, do you have control over that? No. If there's an Enron or, one of these companies does something wrong and the company stock drops out of your control completely, well, you lose your money. It's risky. You're giving up control. Where the difference with the whole life, you put it in there and it's growing for you. Then you pull it out and you put it in things like real estate or whatever the case might be. And so when you start to click right there that, hey, I'm not looking at the returns. I'm not comparing returns that I get in this policy, doing infinite banking versus the returns I do in a real estate deal. It's not, should I do this or this? It's let me do both. It's the and asset. So I put my money in this policy and I take it and I invest it into whatever you're investing in. So that's the biggest difference. And when you understand that right there and that starts to click, then this entire infinite banking strategy will make a lot more sense, right?
Yeah, and the other thing that people ask around that same question is, well, what's the risk with this with doing infinite banking? Like that's the other question. And I always say that the risk is it's in the mirror. Go look in the mirror. It's you, the person using the policy is where the risk mainly lies because it doesn't lie with the insurance company. Because these insurance companies, they've never gone bankrupt, they've never lost money, they've never not paid a legit death benefit, they've never not paid dividends. They've been around for over 120 to 180 or more than that years in some cases. So you got to think about that. These companies literally have 100% cash reserves, meaning they can pay every single death benefit today and still do business. Banks can't say that. Most financial institutions can't do that, but these insurance companies can. So we don't really see a risk with the insurance companies holding or with not holding our money, but having our money deposited there. There's not a lot of risk there. It's how you use the policy. That's why we want to educate you on how to use it correctly, because that's where the powers is right there.
Absolutely, absolutely. Let's get to question number three from the BYOB Blueprint 3-day training event. And question number three is, how do I know this isn't just moving money around and pretending it's working?
That's not a question I've gotten a lot, but we did have it come up quite a bit in the 3-day. How do I know it's not just moving money around and pretending it's working? Well, if you look at an illustration, which I just pulled one up, you can see that it's actually working for you right there. You can see the cash value growth. You can see the efficiency of the policy. You can see how it's growing every single year. So, I mean, to me, it's kind of black and white right there. I go, it's right there on the page. And we all have personal experience with this. Some of us have policies that are 15 years old, and they just keep on going up. So to me, the proof is in the pudding, so to speak, because we have the experience and you can see the numbers right there. And also the last thing to mention on these ones, these policies and these projections are very accurate. Whereas like a 401k projection is very inaccurate because they use averages, which is, I cannot believe they even do that, but they use averages and not actual returns. Think about it this way. Think about your money in a checking account. If your money is sitting in a checking account or savings account, it's typically not doing anything for you. It's not growing, maybe by a quarter percent, but it's just sitting there. In fact, it's losing money because of inflation. So your money is losing value sitting in your checking account. Whereas if you borrow that money out of your savings account and put it into real estate, you've just moved it from bucket A, the checking account or savings account, to bucket B, the real estate. It's just gone from there to there. Now it's earning you hopefully a return inside the real estate. So that to me is just moving money around. It's working for you now in the real estate, but you just moved it. With infinite banking, when you put the money into the policy, it is now earning you guaranteed returns and dividends. So dividends are what it earns first. So it's growing for you right there. Now, if you want to borrow money out of the policy and go do the real estate deal, it's still making you the same return in the policy, and it's also making you a return in real estate. So you haven't moved it from one bucket to another bucket. It's now in two buckets at the same time. That's the big difference. The big difference. Like a 401k. If you have a 401k, it's invested in the market. If you borrow from your 401k, it's called a 401k loan. You can borrow up to $50,000 depending on the balance. You borrow 50, your 401k balance goes down. Okay. And now you take that money and go do something else with it. So that's moving money from bucket A to bucket B, by the way. Same thing as the checking account. So I always look at it is your money working for you more than once or just one time? So if you're moving money around, that's just from one bucket to another. So with infinite banking, though, it's called the and asset because you're doing this and this, two things at the same time.
And that's a great thing we just hit on because this anonymous over in the Q&A keeps throwing out these numbers that are just not accurate. They're not real. And we're not talking about an either or situation here. We're talking about an and asset. So it just
So
tells me you have not learned enough about how this works.
yeah, so let me explain to you what I mean by the because they mentioned 8%, 9%. I'll be honest, I would never believe those returns because that's called an average rate of return. So this is how they project QRAs or qualified retirement accounts, and it's just kind of mind blowing. And I've had 401ks and IRAs, so I saw this math in real time. So I'll use a very simple example here to explain how they report the incomes on some financial advisors on the 401ks. If you put $1,000 into an account, a QRA, like a 401k, and in year one you lose 50% of that, your $1,000 went down to 500. In year two, you have 100% gains. So now it goes from 500 back to 1,000 again. Well, what happens in year three? 50% loss again, goes back down to 500, but in year four, you have 100% gains. Now you've got $1,000 again. So you started with $1,000 and you ended up with $1,000. What's your average rate of return? Most people say zero. Your actual return is zero. Your average return is 25%. 25% return is your average return, but you got actually zero. So and Craig, by the way, has done this math in using the actual markets, by the way, and proven this out where the average rate of return is not real. And so I think it's in that white paper. Is it in that one?
Yeah, it's in that video too that I
Yeah.
shared, the buy term
So just
investment.
check that out.
BYOB.
Non-attendee, check that video out because it'll walk through actual math and actual returns in the markets and actual returns from a policy. Yeah. So we've done the math on that one, but that's one thing to keep in mind. And then the other thing to mention when for this question, and this question once again is how do I know infinite banking isn't just moving money around and pretending it's working? Well, one, I said once you put money into the policy, it doesn't actually leave the policy. It doesn't leave it. You can borrow against it, but it does not leave. So it's actually working for you for the rest of your life. But you can do something else with it over here and double your return essentially. But there's other ways to use money that we're not used to. That comes back to the whole mindset thing. So you may have heard of the concept called velocity banking. So velocity banking is just a way to funnel money or flow your cash flow through different financial vehicles to drastically reduce the interest rates that you're paying to other people and pay debts off a lot faster. And you can do velocity banking with typically it's a HELOC is the main thing. You'll hear us talk about those quite a bit, or an all-in-one HELOC, but you can also do it with a policy as well. So if you do this kind of stuff, you're moving money, by the way. So the question is not just moving money. Well, actually moving money around makes it work harder for you. So what do I mean by that? So let's just say that you have a policy or a HELOC or some sort of line of credit, and you borrow out of that to pay off a bunch of bad debt. So now you've got like $100,000, or it doesn't really matter the number, inside of this HELOC or line of credit. Now you got to make sure you pay on that. But let's just say that you make $10,000 of net cash flow every month. Okay. That money comes in. And then what do you typically do? You pay everybody else first. Credit card companies, the banks, car loans, grocery stores, whatever. You pay everybody else first. Well, what's the first rule of infinite banking? We have three rules. Pay yourself first. So in the velocity banking strategy, you would take the $10,000, and this is just simple example here, by the way, keep that in mind. You take the $10,000 and you dump the entire thing into your line of credit. and knock the balance from $100,000 down to $90,000. Why would you do that? Well, because you moved your money around, but now you're not paying interest on $10,000 that you otherwise would have paid interest on it. So you're saving money. So one of the cool things about when you become your own bank or do these kind of things is there's two ways to say it to I guess combat interest. Not pay it, right? So not pay is the first thing, but also pay less. So velocity banking is a way to pay less interest than you would otherwise, and you can knock it down. But in the velocity banking example, then you just use that line of credit to pay for your expenses. So you treat it almost like a checking account. So, but that's moving money around, but it's saving you money and paying debt off faster. So you can move money around and just be wasting time. But if you move it around correctly, you're actually building wealth. And the vault software, by the way, maps that out, what I just explained. I know that was probably kind of, you may not have followed it, but it maps it out. And so there's the vault right there on the screen. But yeah, so this is a big challenge we've had with a lot of our clients. Don't know how to do the system. They forget how to do it. It's been a year. They forget what they were learning from us or whatever. So the vault is a way to actually have it mapped out for you. So that's why we built it, because we realized there was a problem and we wanted to solve it.
Love it, man. Yeah, the vault is definitely a game changer, being able to visualize exactly what that looks like. And I just want to give one more example before we move forward. This was a policy I did for a real estate investor a few years back, and she realized by changing one thing where her money goes first that it would change everything. And so she had just completed a deal, had $150,000 she wanted to dump into this policy. And that's where you see, let me see if I can annotate. So this is what you see right here. Year one, $150,000 going in. And by the way, guys, this is what's called an illustration. I know Brian just showed one also, but this illustration shows you what your policy looks like basically for the rest of your life. And like he mentioned, there's a guaranteed column, there's a non-guaranteed column. We do typically always use the non-guaranteed column because historically speaking, it's very, 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 very accurate. And the companies that we use have paid consistent dividends and met what they projected for dividends consistently for like 100 and some years straight. So while the dividend's not guaranteed that growth, it has been paid for well over 100 years, and the insurance companies do a great job with it. So we typically use that number just to be clear. So you can see what this looks like over time. But remember, this is just the policy, okay? So you put 150,000 in, they have 132,000 they can borrow back out right away to put right into the next real estate deal. Now, $132,000 is not 150,000, right? But what are they doing with this? While this 150 is sitting in here growing and compounding, they're pulling that 132 out and putting it into another real estate deal. That real estate deal is making them even more money, presumably enough to cover that little bit of loss. And then they're looking at the long term because look what happens in year three. In year three, they put $50,000 in. Now they can pull back out over $50,000. So now every year for the rest of their lives, when they put money into this policy, year four, 50 in, grows by 53,000. Year five, 50 in, grows by 56,000. It gets bigger and bigger and bigger every year for the rest of their lives, while simultaneously they're pulling out all this cash value and using it in other investments. Okay. It's going to grow like this, whether they're using that money or not. So use that money to grow your wealth while you have your foundation sitting here growing for you into the future. So over time, what happens? Let me show you what she wanted to do active real estate and then eventually become a private money lender. So we did this example in year 8 of having her policy. Her cash value grows by 66,000. She put in $48,000 premium that year in the 8th year of this thing. Okay. So puts in 48,000. It immediately grows by 66,000. All right. So that is $18,000 in growth, a 37% cash on cash return that year. And remember, it gets better and better and better every year for the rest of her life. All right. So in this scenario, she decided to take the cash value, do a private money loan, making 12% that year on the private money loan. Well, her bank grew by 37% that year, the money that she put in that year. She does pay 5% interest to take the money out to use it. So if we do the math right there, she just made 44% return on her money. Now, what is the one thing that she did differently than what she was doing prior? Well, before that $150,000 was going to Chase Bank or whatever bank she banked with. That 50,000 would go to her business account and keep going there over. And then if I put money in Chase Bank and then I pull the money out of Chase Bank, does that money in Chase continue to grow? No, they give you the money back. It's not any longer growing. So that's the biggest change. She's changed where her money goes first. So instead of putting her money in a Chase bank, she puts it into her own banking policy. So because she made that decision 8 years prior, now instead of making 12% of that private money loan, she's growing her money by 44% that year. She did nothing different except where her money goes first, that she started the banking system 8 years prior. And again, it just gets better and better and better every year for the rest of your life. So this kind of highlights that it's not should I start a policy or invest in real estate? It's let's do both. It's the and asset and have our money growing two places at the exact same time. Does that make sense for everybody? Make sense, Brian?
Nope.
All right, cool. Yeah, no, right? All right, so here we go. Ready? Question four?
Yep. This is an interesting one. If I never do a deal, does this still work? So I since this was part of the 3 day, what I'm assuming they're referring to is like a deal, like real estate deal, a note deal, a mobile home, something like that. Because we didn't have real estate people speaking at that event. So no, by the way. So the number one thing that people do first with infinite banking, the first thing, get rid of that bad debt. It's actually not even a deal. It's actually getting rid of the bad debt because if you want to build wealth, 2 steps, get rid of bad debt and create good debt or put your money to work, right? So the first thing is get rid of that bad debt. So that's the first thing people do. But keep it in mind that when you borrow from a policy, infinite banking policy, that's just cash that you now have in your hand. It's just cash. What can you do with cash? Anything you want, literally anything you want. So as far as a real estate deal goes, it's just cash going into the deal. You can put it into your business to private lend it out. You can buy a car, pay for college, get rid of bad debt, pay for a wedding. I mean, what you do with cash is unlimited, pretty much. So it's not deal specific or deal dependent, by the way. Um, and then the other thing to mention as well is if I never do a deal, does this work? Well, we have people that they realize I don't have a deal to do right now, but I want to do a deal. And hey, if a deal does come up, I've got to be ready to take advantage of it. If you wait until you have a deal to do infinite banking will probably never happen because it takes time to set it up. You got to fund it. You got to have it grow for you. So we have a lot of people that do policies as a way to store their money somewhere else, have the guaranteed growth, have all the tax advantages, and have it be protected, by the way, as well. So in most states, it's a protected asset. Also, these policies are private. Private means they don't show up on your credit report. They don't show up on, on other statements, that kind of stuff. They are private. So it's also considered, by the way, a liquid asset. I don't know if most people know this. We don't talk about this very often, but a life insurance policy is considered a liquid asset. So if you've ever filled out a personal financial statement or net worth statement, almost always is going to have a line item in the assets column, by the way, the assets column that says life insurance cash value or life insurance surrender value. And what they're referring to is the cash value of a policy. You can put it on your net worth statement. And so but these people, they'll put it in there and then they have it ready for when they do have a deal. So I've had so that the Ken McElroy, by the way, the gentleman I mentioned that was one of Robert Kiyosaki's real estate guys, that's what he did. So he had these policies that were there. He had a whole list of people that had policies as well that were just liquid sitting there. When the market crashed, they were still liquid, and so they were able to take advantage of the deals when they presented themselves. So to answer the question simply, yes, this still works if you don't have a deal because you can do anything else you want with it. So.
Yeah, and I always say, Brian, I mean, it's your money has to go somewhere, right? And so
Yeah.
even if you started a policy and you never did anything with it. You never used it for infinite banking. You just started the whole life policy. Well, one, your money's now in a vehicle in an environment that's tax-free growth guaranteed for the rest of your life. It's liquid, so if you need it, you can access it. You can pull it out in the form of a loan. You can use it later on in life for retirement. You can do an RPU with the policy, something like that. It's protected from lawsuits and judgments and things like that in most states, and the death benefit. So it creates a legacy. It creates something for your family. If something, unfortunate happens earlier than expected, or even, later in life when your graduation date comes. And so, regardless if you never used it for infinite banking, you're still being a lot smarter with your money. So why not? And so, get started with the policy now, even if you don't have time to figure out what to do with it or to figure out your debts, but do that as soon as you can. But it's there for you. So get started. The thing with compounding interest is compounding interest takes time. The sooner your money's going to start really growing and compounding for you. I mean, the biggest example of that is, like Brian, would you rather have a penny today or $1 million today or a penny today that doubles every day for the next month? And
Yeah,
obviously a penny that
penny.
doubles is going to turn into like $5 million. But guess what? If you look at that penny in 20 days instead of 30 days, in just 20 days, it's a much smaller amount, like a few $100,000. So because by waiting, let's say you waited 10 days to make that decision, you only had 20 days to compound, well, you're giving up a ton of money. And so get started now, figure that out, and we'll use it later. But all I know is you're better off with it than without it, regardless of if you ever use it, right?
And it's also a mindset thing too, because like if you talk to a real estate investor, to be honest, they're not that question they're not going to answer. Or I mean, they're not going to ask that question, I should say. They're not going to ask it if they're a real estate investor. Why is that? Well, I guess I should say if they're a successful one. Because let's say you own rental properties, which I've owned rental properties before. I don't currently have any, but I've owned them before. So if they're paying me $1,000 a month in rent, what am I doing with that $1,000? Well, I'm going to service debt if I have any debt, but I'm going to take 10% aside and put it aside for capital expenses. Capital expenses are things like a new roof, water heater blows up, need a new dishwasher, furnace, etc. Because I know those events are going to happen down the road. So I'm going to save up for those things. Well, what's different from a policy? Hey, I know there's going to be deals down the road or things I'm going to need to use this policy for. So of course I'm going to start today so that when those things do come up, I might not know what they are, but I'm ready. And so one of the biggest things when I owned that other business that was doing financial education and I was studying underneath these very successful people, what I realized they do a lot is they prepare. They prepare for things that they know are going to happen, but they don't know when or what is going to happen, but they know something is going to. And a lot of those individuals, I found out, by becoming friends with them, they're doing infinite banking as one of the main ways to store this. So if someone asks that question, I always will say, well, let's go look at what the most successful people are doing and their funding policies so that they have the liquidity when the opportunities do come up. Of what I've seen people use these things for unexpected things was one, a wedding. I remember that was one. And he kind of thought he's going to have to pay for the wedding, so he was saving it up and set the policy for like 5 years. I remember this acquaintance of mine. Um, he had his engine blow up in his vehicle, and so typically he would have just gone and got a loan and got another vehicle or something like that. But he had the policy, so he went and had the engine replaced, I guess is what he did, and then kept on doing it. But he had the money available to do that. If he did not have the policy, he would have had to go get a car loan and pay interest to a bank. So by having this thing liquid for him, he was able to pay for it himself. Trying to think what else I've seen people use these things for that were unexpected. I actually did have somebody replace a water heater and a furnace in a rental home. Something happened to it, and I don't think it caught on fire, but something happened. So they used their policy to do that. So they were taking their 10% of the rental income, and they had a portfolio of assets of rental properties, and they're putting all that, the capital expenses, into the policy, and then they use the policy to pay for the repairs. And so they created this little system where they kept the money in their own world, their own banking system, and then it just paid for itself. So if they had to go pay for a water heater, they would just have the rental properties pay back the policy loan, and there you go, kept the whole thing going. So there's
Yeah.
there's lots of things you can use these things for to you know
Yeah, no, it's awesome, man. I mean, it's
yeah
very similar to just buying land. You own the land, you don't have to build a house on it, but it's got value, it's appreciating, you have control of it, you have options, and it's a great way to look at that, just like a whole life policy that we
yeah
specially designed.
we
Just to be clear, these are not whole life policies you just get from anybody. They are specially designed. It starts with the proper mutually owned insurance company, then the right product, then the right design. And that is what we are very, very, very good at. And I
yeah
would like to say the best in the country at. And that's what
yeah I'd
our
agree.
agency shows. And not only getting the policy started for you the proper way, but the support, the ongoing support for life. We're there for you to help you with whatever you need, new strategy, whatever the case is. And so I would encourage all of you, if this is something that makes sense, you want to explore more, schedule a call with Brian, schedule a call with our money mentors. We'll talk through that with you. If you'd like to learn more and you really want to dive into all the other areas of what we talk about as far as investing in opportunities, private money club, private lending, real estate investing, trust tax strategies, and the rest, you can buy the recordings for the 3-day blueprint event that we just completed, the BYOB blueprint that takes you from mindset right through banking, right through investing, and everything in between. So you guys can do that. But with that said, Brian, I think
Yeah.
we got everything, unless there's any questions I'm missing, but you want to close it
No,
out?
I think you mentioned the one from Melissa. You mentioned that one. Yeah, you can borrow. It depends on how the policy is set up as to how much you can borrow at the very beginning. And then as far as how much the company's not really, I don't want to say they're getting paid. Like actually, so here's the thing. I'll just mention this really quick. The insurance companies are actually upside down on these kinds of policies for the first 7 years usually. So they're actually losing money for the first 7 years, but they think so long term that they don't really care. I mean, I'm sure they care, but these are long term policies. They're not short term. So yeah, so the insurance companies once again upside down for the first 7 years, but we'll explain to you those numbers because they're very specific to the individual.
All
All
right,
right.
great. Well, as long as we don't have any other questions, appreciate everybody being here
Yeah.
today. Like I said, get the call scheduled. You can get the recordings. It's beyourownbank.com/BYOB dash blueprint dash replay. And those are available. And we look forward to working with you. And we'll see you later today on Ask Me Anything and next week on another wealth webinar. So have a great day. Talk to you soon. Thank you.